Arun, Managing Director, Matrix Partners India; Ashish, Partner, Bloom Ventures; Arun Raghavan, Managing Partner, Arali Ventures; Kunjan, Head, RPG Ventures; Kritika, Senior Vice President, EDM Capital. Just before we kick off the panel, we will have a short presentation by Startup Tamila, the first ever reality TV show promoted by a state government. To present the highlights and show and how VCs can participate, we invite to the podium the co-founder Balachandra R, who will highlight how VCs can be part of the show. Thanks, Bala.
Good afternoon, ladies and gentlemen, and thanks to Venture Intelligence team and Mr. Arun for giving this opportunity. I stand here on behalf of the Tamil Nadu government. We always Tamil Nadu has been silent at whatever we do, although it's the second largest contributor to GDP, and there's been significant growth in startups. You know, we always are looked at perceived as not a very startup friendly state, but the government has been in the last 2 years taking up a lot of effort to create a conducive environment for startups and also for investors to come into Tamil Nadu. So we are presenting to you today what is one of our initiatives, which is Startup Tamara. It is uh, it is the first business pitch reality show backed by a state government. So it's is a business pitch for startups and MSMEs, but first time it's backed by a state government. So that's what I'll share with you today, and it's a private public partnership which we are working together. Startup TN is the Tamil Nadu government's startup department, which is run by the CEO, Mr. Sivaraja Ramanathan, and he himself is an angel investor for the last 2 decades. And Startup Tamura is the brand that we will be launching the program in. Although it's a business pitch reality show, it will be a platform that will run throughout the year, which will serve as a uh, you know uh, amplifying the efforts of the ecosystem to a mainstream audience, which will enable to increase the awareness among startups, startup investments, and activities in Tamil Nadu, and so on and so forth. So, why Tamil Nadu? We're the number two state in terms of GDP. We are growing towards a US 1 trillion economy. Startup cluster for SaaS and deep tech and EV sectors, we're quite strong. Everybody knows that. Uh, in the last month, when central government released the ranking of startups, we were in the top three. So that was a surprise for many. But this is why Tamil Nadu is happening for startups, and we want to, on the behalf of the government, welcome you to invest in Tamil Nadu. We believe that this kind of a why many of them said, why is the state government getting into reality show? It's not a domain for governments, but we feel that this particular reality show can change the perception about Tamil Nadu and have an IPL like effect. Post IPL, pre IPL, you know the change in cricket in India. Now we can field almost like 3 international teams. So we hope that both in terms of the supply and demand in Tamil Nadu, this television show will reach the mainstream audience and change the perception for entrepreneurship and investment. So I will not get too much into the details of the show, but it's going to be a 13 episode show for the first season. We have signed for 3 seasons, and there are already we have been running applications for the last 2 months. We've got 1,500 applications. Our team is working on, and the investment committee is working on narrowing down to 50 applicants who will get on stage. There's already about 250 crores which has been committed by lead investors, and you can be part of the first season now, which will start off a shoot in April and May. Some of the people who have confirmed to come on board, obviously it's a state government sponsored show, so it's going to be in Tamil, but it doesn't mean that only Tamil investors can come in. The only predicament for startups to participate is that they should be registered in Tamil Nadu, but we have the who's who of Tamil Nadu and Tamil ecosystem. Dr. A. Velumani created Thyrocare, Reflex Capital, Mr. Sivaraja himself representing the government. Government has a TAN seed fund of about 100 crores. They are investing through the show as well, and few other venture capital titans. And there are multiple celebrities who will come on the show as well, who will be endorsing and as well angel investing into the brands. So we just to take you through a quick screening process that the government will be taking all the startups through. It's a 5 step screening process, starting with a video pitch and a live pitch. And then there's an investment committee, which is going to be led by none other than Mr. Arun Natarajan of Venture Intelligence, comprising of all other lead investors. And finally, the pitch on TV will be the fifth stage. So we are here to invite you to join us as any of the above. As a lead investor, there is a certain criteria you can commit. It's just a investable capital that you can commit. There is no hard commitments that you need to make. You can also come in as an institutional investor where you don't have to commit any figure, but just come and figure out what Tamil Nadu startups are doing, understand our ecosystem. You can come in as part of our jury, be on TV in case you can speak Tamil. That's an option that you have. Angel investors here would feel it's a good place to plug in, maybe discover a few SaaS companies very early. So, and few others here who are service providers would want to come in as partners, establish yourself in Tamil Nadu. I think what better way than to partner with Startup TN? We have about 9,000 plus registered startups and a few lakh MSMEs. So these are the different types of investors, lead investors, investment committee. I'll not delve more into this, but why join Startup Tamara? We are going to give you curated deals from the best in Tamil Nadu. So from about 1,500 applications, you will have access to level A about 300 or level B about 50 startups. So it actually gives you a very focused representation of what good entrepreneurs in Tamil Nadu are doing. Second, it's government backed, as I told you, so there's credibility of the state government backing it. This is one. A third advantage is that this can be your plug-in into Tamil Nadu. We will be offering you various facilities like, ready office space, setup of meetings, coordinating for you stuff in Tamil Nadu. So that is a service that Startup TN will provide. And last is, of course, visibility in the market. When you get to a state, you also need to network and be visible. So what better than being on mainstream media to be visible? So these are the reasons why you should be here. These are some of the set references. These are the launch pictures when we did the program launch, and that's when we saw suddenly 1,500 startups registering as well. This is the stuff that we have been in through the press. So what next? So for us, we as Startup TN welcome you to Tamil Nadu again. We will facilitate your entry and help you with various aspects of you wanting to invest into Tamil Nadu. Myself and my colleague, Mr. Arun Karthik is here. Arun, if you can stand up. So we are here for the evening. So please feel free to reach out to us and we will help you, through your journey as you want to come in to Tamil Nadu. We are also organizing an annual beach pitch. So all of us who are bored of taking pictures in the boardroom, March 16th and 17th, we have 100 curated startups who will pitch to about 50 VCs and PEs on Mahabalipuram Beach. So that's something that you might want to enroll to. Even if you don't find any startups in the first season, I think if you start coming, this will be an annual event where you can kind of also relax at the same time discover some good entrepreneurs as well. The last way is, of course, you can join Startup Tamara platform through any of either being a lead investor or part of the investment committee, and we both will help you for that. Sorry. I think that's it with me. And thank you so much once again, Arun and Venture Intelligence, for this time. And it's a wonderful event and happy to be part of it and happy to see that the VC and PE industry is growing from strength to strength. And all the best to each and every one of you for great growth in the business this year. Thank you so much.
If panelists would like to.
We look forward to seeing you in Chennai. Thank you so much.
Thank you, Bala. Now we would start up our panel session. I would like to introduce the moderator, Vishruta Kaul Trilegal. Vishruta Kaul is a partner in the corporate practice at Trilegal and has over 15 years of experience in acting on M&A, private equity, venture capital, and restructuring transactions. She has presented all types of stakeholders, including promoters, investors, companies, sellers, and buyers in over 200 transactions in industries ranging from entertainment, e-commerce, retail, healthcare, fintech, NBFCs, manufacturing, etc. Apart from her expertise in inbound and domestic transactions, she advises Indian companies on their foreign investments and acquisitions and has successfully managed multiple investment projects by Indian acquirers in overseas jurisdictions. Vishruta also regularly advises clients on various legal issues such as corporate governance, policy matters, compliance, exchange control, and other government regulations. Over to you, Vishruta.
Thank you very much for that introduction. I'm Vishruta, and as I was introduced, I'm a partner at Trilegal. So, firstly, thank you all for coming this afternoon and joining this discussion on venture capital. I think we're set up for a great discussion today because we have a marquee panel with us, which represents um, a spectrum of experience in venture capital investing, right from pre-seed, seed, Series A, B, and beyond. So without further ado, and before we begin, I'm going to request the panel to please introduce yourselves, starting with Piyush.
Good afternoon, everyone. I'm Piyush. I head Aditya Birla Ventures.
Hi, good afternoon, everyone. Ashish here from Bloom Ventures.
Hi everyone, this is Tarun Davda. I'm a partner at Matrix Partners India.
Hi, this is Kunjan. I lead RPG Ventures, the corporate VC arm of the RPG Group.
Hi, this is Kritika. I lead in ETM Capital. We're an investment banking advisory firm based out of Bangalore.
Yeah, I'm Arun Raghavan from Arali Ventures, a seed stage investing firm.
Wonderful, thank you all. Um, so just a little bit on the format of this, we're going to try and keep it very interactive. So I will request all of you to chime in with your comments and thoughts on any of the questions. We're going to keep about 15 minutes at the end for Q&A. We're going to try and cover a host of topics on venture capital in the next 45 minutes. So I will begin with Ashish. Um, what is your reading of the state of the early stage investing ecosystem? Everyone's been talking about a funding winter. Has a thaw finally set in? Are we going to see deal activity like we did in 2022? And why are all the funds sitting on so much dry powder?
Thanks. So let me break this up into two parts. When we talk about the funding winter, there are parts of the ecosystem which definitely are extremely dry. And there are factors. We have discussed a bunch of those all through the last 18 months, and I'll not deliberate too much, but they are obvious. We had a massive overheating all through that phase of 2021, and we saw a significant correction. The fundamental thing is a balance. I think if you're not going to get to a semblance of balance between check receivers and check writers, we will continue to see extreme cycles. My sense of the ecosystem as it stands today is that from a end of the year timeline, I do feel that it will definitely get better from what it was all over the last 6 quarters. But I do feel that there is a little bit of pain to come until we see all of the bad news is out, until people get a comfort around where the valuations lie today, until we see a few more clear-cut guidelines or the clarity of thought from certain regulatory aspects, we see on and off on the fintech side as well. So there are a few more things still to come, is what I do worry about, and that makes me believe that it'll get a little worse before it gets significantly better. But the hope that I definitely believe will be is the timeline will be sooner, because we are finally seeing a fair bit of balance in terms of overall economic talks, whether it is interest rates. And I also anticipate that conflicts existing in various parts of the world won't continue significantly longer. But the next 3-4 months definitely look a little too unpredictable.
Okay.
we have as a from where we are at the GDP, and that should define the check sizes at which companies get priced. And so, yeah, it's a combination of both of these.
Right, I'm going to come to that actually. That's an interesting theme on why are we so obsessed with unicorns? Should we be? So we'll talk a little more about that later. But first, I wanted to ask if any of the other panelists want to come in on their question on this question. Tarun, would you like to contribute? Arun, yeah.
So, our experience has been a little bit different. I think, boom and bust cycles are just part of every sort of, country as it goes through this phase. So I don't think what we're seeing is very different. We've always historically had, 2-3 years of a boom and then 1-2 years of bust, and then there's again boom and bust, and it's just the nature of the industry. At least our experience has been, we don't have a target as a fund, but we end up doing anywhere between 15 to 20 investments a year. And if I were to rewind back in 2021, when I think everybody was going a little bit overboard, we ended up doing the fewest number of investments we've ever done as a fund. We did 7 in that year, when some of our peers were making 30, 40, 45 investments. And I would like to take credit that we were smart. That wasn't the case. We just couldn't make sense of what was happening, and we came close to doing lots of investments, but you know entrepreneurs were getting multiple term sheets, higher valuations, and at some stage you just say, what, okay, this is not making sense, right? And so I think had that continued for another year, I think we would have got FOMO and started doing stupid things. So thankfully that didn't happen. But in 2022 and 2023, we've actually done, I think, 16 and 18 investments each. So we're back to our pace that we were earlier. Honestly, early stage is still very, very buoyant. At least that's the way I see it. Overall deals in the market are few, but the quality opportunities haven't changed, which actually makes our job easier as venture capitalists, right? Because in an environment where anyone is starting up and is getting a few $1 million to chase that idea, it actually makes our life difficult because I need to sift through so many more opportunities to find that quality set. Now, founders are actually self-selecting themselves. I mean, you need to really, really have conviction and be doing this for the right reasons to start up in 23 and 2024. And so I think our deal pace has stayed the same. Valuations are down by 30%. So what used to be a Series A round at 30, 35 post is now happening at 20, 25 post. Would I like it to be 15 post? Yes, but reality is we all operate in a market and are forced to be competitive, and so we end up doing that. Contrast this to late stage. So late stage, actually, it's almost in a paralysis right now, right? Growth checks above 50 million, I don't think are happening in the market at all. I think all the late stage investors are kind of taking a pause, want to see how their earlier bets have panned out. And I think what it will take, none of us can predict how long it will take for things to correct. But I think the trigger will be, let's say, Ola Electric and First Cry and a bunch of these companies that have filed for IPO. If they are able to successfully go out of the gates, what will happen is I think that will trigger money flow back into late stage as well again. Because right now, I think people are just, there's always this 20-30% gap between, to his point, the check writer and the check receiver in terms of price. But once these IPOs are successful and people understand what public markets are willing to value these companies at, I think, fingers crossed, we should see some, recovery happening.
Thank you. I know Arun.
Yeah, I pretty much echo Tarun's view, right? I mean, we've been investing from 2018, right? Like Tarun mentioned, we sort of paused during 2021-20. Our typical deal flow, we do 4 or 5 deals a year. We have a slightly more operatorish approach, work with the companies, and we only invest in B2B tech. That's our background. That's where we come from. 2021, we had to actually just step out of the market because it didn't make sense, right? But having said that, last year has been our most prolific year. We've done 11 investments so far. So from an early stage perspective, it's been, we had really good deals coming up. Entrepreneurs, like you said, self-selected themselves. And it's been a good hunting ground. Obviously, valuations are down. So we're happy to go back and invest at the current levels rather than at atmospheric levels that were there in 2021.
Okay, great. Thanks.
Maybe I'd like to add what had also happened in the last 3 years, the reference point somewhere had changed. I mean, if you look at 2023, the kind of funding that has gone in PVC, they're essentially the same, if not slightly more than what it used to be till 18-19. So I think pandemic and post-pandemic, simply because of a variety of reasons, shot up the whole deal flow. the money that's kind of going in now has kind of come back to more of a realistic sort of a number what it used to be. So while we call it funding winter, it's not really a funding winter. Sarun said, right kind of opportunities are still there in the market and they're still able to raise money. The valuations have come down to a lot more realistic level. Second, I think to another point which got discussed is the kind of indicators coming from capital markets, especially primary. The moment we see a lot of successful IPOs happening of startups, which raise money, I think late stage startup now, that has a ripple down effect on the funding that goes into early stage because that sets the tone, a very optimistic tone for private investments. So my sense is to the second half of this year is when we will see the kind of buoyancy in the early stage investing, but it may not be same as what it used to be 21, 22, but it'll be a lot better than till what it's to be 18, 19.
Kritika, what sort of deal flow are you seeing? Are there any particular sectors that you think are sort of attracting more interest?
Sure. So, I'll take a step back. I mean, it's less about the sector, I'll say, and I agree with a lot of
Types of companies or
absolutely right. So I agree with a lot of what our panelists have been saying today, in the sense that number one, of course, there was a euphoria post-COVID, right? So 2021 and a part of 2022 as well. The deal flow was insane because we do track, how many deals are happening, and our newsletters used to go into like 3-4 pages in terms of every month how many transactions are sort of happening, right? What's happened off late, at least in the 2023 year time frame, is a the general, I would say, upsurge from a consumer demand perspective that was there settled down a bit. Investors got a bit more cautious because there were some stirrings in the west, right? And consequently, what's happened is more people started saying funding winter, while deal flow just A came down to a pre-COVID level, as he rightly pointed out, and B, companies that are sound unit economics, which are profitable, which are perhaps properly growth stage. And again, I'm coming from a growth stage perspective, not an early stage. They still had, investors lining up to sign term sheets for them, right? So it's more a switch in terms of where the investor interest has lied, and therefore consequently self-selection of the right kind of founders was sort of now getting funding, and hopefully the trend will continue going forward. Like you said, there's a lot of dry powder left, so fingers crossed.
Okay, I want to bring Kunjan into the discussion. How is your approach to early stage investing different? Do you think you have a certain advantage when you pitch to a company? Are you sort of viewed as more patient capital?
So I'll switch patient with strategic capital. And that's how we position our business to companies and founders, right? I mean, from a process approach perspective, it's similar. Peers over here, look out for companies, look out for sectors, have a viewpoint, draw personas of what kind of jockey you want to back. But when we approach them, we know who we are, which is a corporate VC, right? So yes, we come in there with capital, but we also come in with some kind of like strategic guidance, vantage point that they can benefit from. As long as they see value in it, and of course we go into describing how they can get the value in it, past examples also. Then we have a meeting of minds, and then it's about just waiting for the right opportunity, waiting for the right round to come together, and then partnering with the right financial VC to do the round. So I would say it's more strategic capital that they see value in rather than patient.
Piyush, would you like to also sort of offer your perspective on that? You have a similar.
Sure. So I think as investors, we are highly quality conscious. Our game is make selective deals, but make deep deals, and back the right sort of guys. So from that perspective, we also believe if the kind of opportunity that we are chasing, there's no dearth of good capital for quality opportunities, and capital can't be a differentiator. So the framework that we use is called Capital Plus Plus, where of course you bring in capital, but you also bring in credibility and most important, the capabilities of the ABG's ecosystem. While these are financial investments for us and definitely like other investors we'll exit, but in terms of capability, we operate at three levels. One is of course the clear-cut business opportunities. So let's say we invest in a company and there can be a strong business synergy with any of the group companies. We are there to put them in touch with the right sort of decision makers. Of course, decision is there's a business decision, but getting the right kind of audience, etc., makes a lot of difference in terms of seriousness, speed. Second model that we use is called strategic mentorship and guidance. So across the sector that we invest in, there's a clear pool of CXOs and business leaders who have run business in India internationally, who engage with these founders at a more strategic level, open the right kind of doors, advise. Third is a lot more tactical, in which we bring in a lot of functional expertise. These are, let's say, SBU level heads, the head of store expansion, which can be very handy for a consumer brand we invest in. This can be somebody who is, let's say, supply chain head for a particular, let's say, industry or a consumer business. Again, they help develop the whole supply chain piece in the, let's say, company we invest in. So typically, business, strategic mentorship, and functional expertise. So these are the three levers we use very extensively in any company that we invest in.
Essentially, you're able to sort of leverage the strengths of the corporate group and sort of help portfolio
Absolutely,
companies in
and
that way.
completely on an
And I
arm's length basis.
and that would probably be the same for RPG Ventures.
And I think the learnings are two-way. It's not like we are just adding value by being shareholders or sitting on their cap table. I think we as a group have a lot to learn from these companies too. The startups that we invest in. Their agility in approaching business problems, their mindset. They are good sort of takeaways for a large organization, large conglomerates like us.
So thank you. I'm going to move on to the next question, which is I want to touch upon one of the themes that Tarun you mentioned, which is that investment happens in cycles. There's ups and there's downs. Why? I mean, so I guess my question is, what is your view, Ashish and Tarun? What is your view on down rounds? Should they be just viewed as part and parcel of the life cycle of investing, or should they really be seen as draconian events for a company?
So let me just take it a little top down. In the end state, most of the investments that all of us would end up making, other than those which are made directly from a strategic lens, would end up being done so that the business eventually becomes a listed entity. When you look at it from that lens, markets do go up and down. And so what's happening? It's effectively a down, down, up, down every day, or up mark, down mark every day. So when you try and extrapolate or stretch that argument to an early stage, it is a repricing suited on a variety of factors. So when we have gone a little overboard one way or the other, or over conservative in a weak environment, it will throw up some of these corrections. And I think those are, from a long-term ecosystem point of view, those are realities. I definitely do understand that for a founder and for the manager of that investment in a fund, these are big movements and they will matter for sure. So we cannot just simply wish it away and say that, yeah, part of life, let's move on. But at the end of the day, I think if you're building a business from a 10, 15, 20-year lens, and we have been stuck in a rut for capital flows not coming and had to do a valuation which is very low, a ecosystem will bounce back at some point in time and give us a massive up round, which did happen once in a while. In the last 10 years, we have seen one or two phases. And then we have seen three phases of exaggerated activity, which has led to a fair bit of correction as well. So we will have to take it in that lens. We can't really bring it to a point where we make heavy weather out of it to the extent that it affects the ability of the company to take more capital if it is available at a lower price than what it was. And neither it should prevent a fund manager from guiding the portfolio to do what is the right thing, which is to insulate the company and make it profitable in the long run.
Right. So that was actually going to be my follow-up question. Maybe Tarun, you could answer that. Um, I think Ashish is saying that it is part and parcel and it needs to be accepted. How do you, as funds, steer your portfolio companies through that experience?
So, by the way, I agree with what Ashish said. I think the reality is down rounds happen in public markets every day, and so I think we just tend to make a big deal out of it in private markets. Um, I'll give you an example without naming the company. We had a company that was getting an offer at a lower price. Every other shareholder or every other investor on the cap table advised the founder to wait. We were the only fund, at least in my to my memory, where we said, you know what, this doesn't matter. Eventually, market determines price. Your job as the founder is to think about capital and cost of capital. Those are the only two things that you can control as a founder. So if you need X, figure out if you can make do with X minus. What you control is dilution, right? And so, fine, you know what? You're not getting capital at the terms or price that you may like. Raise less, but take the price that you're getting, because your number one job as a founder is to keep the company alive and to make sure that you don't run out of cash and run away. Now versus raising 100 million, you can maybe raise 50 or 60 million, right? And so our advice always to founders is, don't optimize on the valuation, because end of the day that's a notional number until you go public. uh, Optimize what you can control, which is the amount of cash that the business needs, and optimize dilution, right? Because those are irreversible. Once you've taken a call to dilute X, that's not changing. But the valuation technically will change every day as it changes in public markets. Second thing, and this is slightly different again, we've seen, especially in the last 2 years, lots of these sort of what Bill Gully calls dirty terms, right? Which are structured deals, which have guaranteed returns, pseudo debt, PIK, convertible, repricing, and like all sorts of stuff.
Those happening right
Yeah, and our advice to our founders is always like, listen, that's just you're just postponing the pain. At some point, these terms are going to catch up with you, and I would much rather take a clean lower price than holding on to the last round price, just because you know what, vanity or whatever we call it, right? Like we accuse founders of looking at vanity metrics. I think as investors we're equally guilty of focusing on that one vanity metric.
Yeah, I think we also have those crazy anti-dilution clauses in our SHAs.
Yeah, and
Sometimes.
our view is it's better to take the pain once and not set the precedent that as a company you are okay with taking these structured rounds, because once these make their way to the SHA, the reality is that every investor in the future is going to expect some version of those same terms, right? Because they know that as a company you have accepted that, and you can't then rely on precedents and say, I have never done this, I have never accepted this historically, it's not fair to my past investors. Come back, give me a lower price, but give me the terms that are sort of pari passu, right? And so at least our philosophy always has been, take the pain today, because if you don't, then it's a falling knife. You don't know where those terms in the future. Like, I as an investor don't want to be in a company where I actually don't know how much of the company I own, right? Because when it's a convert, when they have all these fancy structures above it, you know in the cap table will show I own X, but I could be owning X minus minus, I just don't know. And so at least that's the way I look at it. I think we just collectively as an ecosystem make a big deal about it that we shouldn't be.
Right. Kritika, how do you think founder expectations have changed in the last 2 years?
Okay, so I'll split this into two parts. So we do two sectors, right? So we do tech, which is more aligned with what everybody here invests in, and we also do healthcare or hospitals. On the tech side, we're absolutely right. Like in the last 2 years, yes, the market went up. There was a euphoria. Everybody wanted high valuations. Then the market went down, and it corrects, and it happens like everybody was here talking about every few years. This is not the first time we've had an up and a down in the last 10 years, right? And consequently, I think now that there is a down, now that there is, I would say, a bit of concern to get capital. Promoters are also sort of learning and partly advised by investors like these to say that, you know what, if we have a burning loss making vertical, but we think that that's the future, let's take a pause on that. Let's take some harsh decisions. Let's not burn unnecessary cash. Let's try to conserve capital. If we get money, let's raise it, even if it is not as high a valuation as we wanted it to be. Right. And then let's focus on getting back to profitability, because we know that once business comes back a year or two down the line, there will be a big payback, right? In the future. The fact that it's not short term, it's more a long term business, and there is always going to be ups and downs. And that's something that I think promoters are slowly realizing on the tech side. But on the healthcare side, on the other hand, right? I mean, these guys are old, traditional entrepreneurs. Their view of the markets is how public markets move. And public markets in healthcare, especially post COVID, actually significantly ramped up, just like tech, right? In 2021, everything was trading at a peak. 2022, everything fell a bit. And then now they're seeing it sort of slowly come back. So they are saying these guys are basically sitting on pools of cash because they have a lot of internal accruals from their post-COVID era. They are seeing companies list every year. Two health hospital companies are listing every year, all of them doing well. And we are seeing increased investor interest, private equity investor interest in the hospital space. So they are actually significantly more optimistic. They want to, reinvest capital, build, grow. Some things might succeed and some things might not. But fingers crossed on how I would say the next 2 years pan out from a hospital perspective. But yeah, that's the.
Okay. I'm going to move on to a different theme now. I think let's talk about AI for a little bit. It's a big topic of discussion. It's attracted a lot of capital overseas. India typically has been a follower when it comes to technology adoption, whether it was, smartphones or cloud computing. But I think on AI, we've sort of kept a pace. Arun, let me start with you. What is your sort of outlook on AI in India, and what are some sort of exciting opportunities that are happening in India in this space?
Yeah, so I mean, it's AI is a reality that's bound to happen, right? I mean, you just can't run away from it. It's been shown that there's going to be significant shifts in how businesses will operate, how they have to leverage AI, right? And even if you just look at what kind of product it can drive, right? It's going to be a big shift in terms of what it will bring to the table. We typically invest in enterprise software, right? That sector, enterprise technology, that sector is going to be seeing a tectonic shift because of AI. What I mean, but it's not new. AI is not new relatively. It just become a buzzword now, right? I mean, you had various forms of AI that's been there for last 4, 5 years, 6 years. Enterprises, I mean, startups have been building around it, right? What's made it uh, more proliferate now is basically just that, just Chat GPT and OpenAI basically just makes it even democratic, right? What we are seeing is that see, there will be some sort of, I mean, there's some crazy rush towards AI now. Every startup wants to be AI. But what we feel is AI actually is significantly going to be favoring the incumbent enterprise technology provider. So because what it helps basically incumbents do is go back and ship more faster, go back and win product variation much quicker, right? So while there's going to be impact, right, it also got a lot of things that need to be fixed in the process. There's a huge amount of things that need to work around AI. I mean, that needs to fall in place for AI to be successful. This is like the cloud computing of say 2008, 2009, right? So while we see a lot of activity, a lot of startups wanting to do AI, right, we still think that there is still some way before native AI enterprise technology will actually start. They are starting now, but I don't know how the next 2, 3 years will determine. I mean, will basically be the good hunting ground for native AI startups, and these guys will go back and probably disrupt the existing ones. The cycle will continue. But like I said, there's a lot of hype. Choosing the right company and shifting through the company that are there today is going to be the guy who's going to be the winner.
But I want to also, and please feel free, whoever feels you want to contribute to this question. But Indian fintech has been talked about. I think India's done very well on the fintech front. It's been aided very much by a very healthy partnership between our regulator, banks, and various participants. And is AI a sector like that for India? Any comments there, Ashish?
So I think you brought out the right point, and that's exactly what I was meaning to chime in with as well. If you look at one factor on the back of which we are keeping pace, and I definitely am not going to count myself as getting ahead of myself by saying what I'm saying, that we will probably lead the world on this, and that is the combination of the financial services coupled with AI through the digital public goods infrastructure, if at all, we have demonstrated that to a large extent. And the exports of that infrastructure is definitely going to give a little bit of an advantage to our developers to be able to explore and even exploit the offerings through the AI bit. What the biggest output of this is going to be is personalization. And I do feel that amongst the various verticals, health and financial services are going to see a massive amount of benefits and broad basing thanks to the combination of AI with each of those respective verticals and technologies that are there. And just to give you an example, Today, when a bank or an insurance business creates a certain product, and both, whether it's organized lending through a bank or whether it is insurance, both have a very tiny penetration relative to where our overall mass of population is. You are trying to create a product which is going to appeal or be relevant to a critical mass of the population. No, even SFB to that extent would not go down the path of trying to create a product which will be relevant to a few hundreds of thousands of people. They would still look at, am I catering to maybe 2, 3, 4% of my TG at the very minimum? Thanks to personalization benefits, you will have products being created, administered, and nurtured with a much greater sophistication and costs. So this is just an example of what AI stands to help us achieve. And there are many more things on both on the enterprise side and the consumer security, etc., that I feel that has an impact.
Anybody else want to sort of come in on this question?
Yeah, no, I think even so beyond fin services, healthcare, absolutely the right spaces, right? But I think, anything around personalization, anything around making choices, could be around travel, it could be around education. I think AI can play a big role over there too. I'm reading this fascinating book called The Coming Wave by Mustafa Suleiman right now. He's the co-founder of DeepMind. He just lists all the fascinating possibilities with AI that can be out there. So I think it's very real. It's very here and now. But I think going back to your point, it's about how we use it in our day-to-day lives also. And I think that even the infrastructure and the tools to make it available and usable on a day-to-day basis is becoming more and more commercially available slowly and steadily.
Yeah, go ahead. I think the only thing I'll add is I think there is also a little bit of coming of age of Indian entrepreneurs that I'm seeing, where I think the success that we've seen in the last few years, I think the confidence that we can now build world-class products from India for the world, I think that's a big theme, right? And I didn't used to see this, 3, 4, 5 years ago, where I would meet entrepreneurs who would come and say, hey, you know what? I will. Earlier, it was always hey, you know what? There's this one company. I can build something similar at lower cost and serve the small and mid market segment, while those guys are focused on enterprise, right? Today, we find entrepreneurs who are saying, you know what? What's so great about what they've done? Like we now have the same talent in India and we can build this. Sure, we will hopefully be lower cost, but that doesn't mean it's a cheap knockoff, right? And I think that's a big change that has happened. Second is, I think, there was a time, and some of us over here will remember, there were companies that said we will be online only. Then there were companies that said we'll be mobile only. Then it's like that, right? Like AI is something which is it's horizontal. There will of course be AI first companies and foundation models and all those good things will be there. But like we have got like 5 companies and the different uses of AI that we are seeing across those companies. One is building comic content, using AI. Obviously, the largest time it takes in building comic content is the time it takes to illustrate every frame. Now with generative AI, I can just describe what I want to see, and Gen AI will actually create that frame for me literally real time. Right? We've got obviously Ola has launched Krutrim, which is building a foundational model and all sorts of other stuff. We've got companies that are trying to reimagine what Salesforce would look like if it were built AI first. We've got somebody else that is building an AI first software for MSPs. So I think it's just like 3 years from today, if any company is ignoring AI and what it's going to do to disrupt their industry, I think they're going to be doing it at their own peril. Like every single vertical, media, content, fintech, health tech, ed tech, I know ed tech is a bad word, but ed tech is going to be something which is highly going to get disrupted by AI, because you can actually now for the first time have a personalization of n is equal to 1, where literally every student will be able to learn at their own pace, and the AI will actually tell them exactly what areas that they are weak on and what they need to brush up on. So I just think it's going to be horizontal, and every single company will end up being an AI company.
So that's a great opening for what I was about to ask next. And maybe Piyush, you can come on that. You've been quiet for a while. Um, do you sort of feel every portfolio company should have an AI strategy now in terms of adoption of AI? Does that also bring about ethical concerns from an investment perspective and a usage perspective, right? Does that sort of increase your due diligence when you're evaluating an AI company or when you're trying to adopt AI for use in your businesses?
Sure. I think first of all, at a fundamental level, AI is something which you just simply can't ignore. We are looking at potentially in a decade or so, AI having an impact of close to $4.5 trillion in global economy, right? And so, be it any company, any industry, of course, the application could be high or low based on the end use case you're solving, but AI is going to play a significant role. So, the sooner you start adopting it as a part of the strategy, the better it is. From a regulatory standpoint, of course, as the space evolves, as we have seen in across other industry, there are a lot of challenges that come up and a lot of regulation that gets set. So AI, it also will go through the same sort of a phase. I think right now the biggest challenge remains with regards to right infringement. We have seen that happening enough of late. So regulation would come around that. Second, I would say is in terms of data accuracy. Now that is something which should get sorted. Directionally, things will definitely get over there. A lot of things from a regulatory point of view should fall in place.
Sure, Arun, please.
I have a slightly different view, right? I mean, whether AI should be there at every startup, no, it's just a function of what markets you're serving and what customers you're serving, right? I mean, we've been talking about cloud for the last 15 years, right? Cloud has been there. It's taken for granted that everything is, I mean, cloud's there. Even today, adoption of cloud is say 20-25% of enterprise technology. Just that, right? There's still a massive adoption of cloud still left to go, right? So there are multiple places where AI is relevant today. A lot of the examples like where consumer facing, you can do personalization stuff. The industries today, on the other hand, the industries today where it's still legacy. You take mining, take any old industry. I mean, the industrial sector, for example, right? They've still not moved to the cloud. So I mean, AI is necessary, but it's a function of who are you serving. Is it relevant for them? Is it relevant in your market, right? And that I think is a crucial aspect of for us at least go back and look at whether AI is relevant. Yeah, I mean, you will probably be not the front runner if you're serving those industries, but does the industry need it? There's a big question that you got to ask yourself, right? And that's I think key because otherwise every deck that we see is like an AI company. Right? You need not be as long as you're serving a different set of customers.
Okay, thank you. Kritika, you want to add to this? Do you sort of advise clients to have something on AI in their pitch books?
So, I mean, agree a little bit with what everybody here said, right? So, I mean, AI is there, and you have to talk about it. Not in your pitch books, but in general when you're when you're talking about your company, right? Um, I'll say so. I'll answer this in two parts. First was about we talked about how AI will change things, how we'll have personalized and to take my sector, health tech, personalized healthcare, and medicine and stuff. I would say that's always been the holy grail of all health tech startups when they started. Uh, I feel we have a very long way to go, no matter how much we try to push, with the digital public infrastructure and NHM and this and that, because there honestly isn't enough digitized data to, have a really like well working or accurate sort of AI to help this out. So it's a bit of a not a short term, but quite a long term goal. But like Arun said, right, not everything has to be about. So again, AI can be anything. AI can be something as simple as a chatbot, right, and it could be all the Gen AI things that we're talking about today. Uh, it's less about whether you have AI the tagline in your pitch book, but more about uh, is AI helping you, become better? Is it helping you sell better? Is it helping your economics? Is it helping you differentiate? And that's what I think is more important to talk about in pitch books rather than just saying, I think this AI ML tag the investors have seen in too many pitch books till now. I think they care more about outcomes.
Substance.
Absolutely.
I think we have only about 5 or 10 minutes before we're going to throw the floor open for questions. So I'm going to ask a few questions on healthcare, which is one of the sectors that a lot of the panelists here have experience on. What are the opportunities you're seeing in the healthcare sector? What are some of the what is happening in health tech right now? Is there an opportunity for a revolution in health tech as fintech in India has seen? Um, can we talk about that a little bit? And I'll invite whoever wants to contribute to this.
So I can go.
Please, please.
So on the, I mean, I would say this is not health tech, but more broadly health and wellness and consumer health. That's a big area. I think
Gynoveda.
yes. So
Right.
that's one of our portfolio companies. But I'll just extend that to another segment also. I think firstly the focus on health. All of us individually recognize that a lot more post-COVID. I think we've all become conscious about making certain choices that help us live healthier lives, and that's where the macro trend is coming from. And following from there, there are obviously various pockets and segments. Sports and active lifestyle is also one of them. Sleep quality is also one of them, right? Yes, we invested in Gynoveda, which is an Ayurvedic brand around women's healthcare. It's actually pretty amazing. I think trend towards Ayurveda similar to the trends that you're seeing in different parts of markets also. It's basically you're trying to live a more naturally oriented lifestyle, right? More greener, more natural, more sustainable. And I think Ayurvedic products basically are in that direction. Or that's with Gynoveda. I think another segment, and this is a consequence of the kind of lifestyles that we live, which I would think will also gather pace over the coming decade, is pain management. Today the kind of lives that we live, socially, professionally, just leads to some kind of burden on us. And I think there are models which are coming out which are taking an integrated approach to pain management. It's just not about physiotherapy, it's about diet, it's about psychology altogether. So I think these are some of the segments that we are quite interested in right now.
Sure, Tarun, you wanted to say something? No.
Space. That's an area I think AI can play a significant role. As long as you have the startup has access to data and has the ability to collect data, and that's the key. Yeah. In some ways, I mean, you can do all the fancy modeling and all of that, but if your data is not great, then you're just going to get bad outcomes. But having said that, if there's a right combination of team plus access to data and stuff like that, diagnostics per se is a big area where AI can be applicable, and we've seen this in the past as we've invested a bunch of companies actually do this, and is there the crucial aspect. Obviously, it's longer gestation and getting buy-ins from the typical practitioner takes longer, but once you're past that, then it's a big opportunity.
And I think one area that's seeing that is drug development,
Yeah,
as well as
yeah,
companion
yeah,
diagnostics.
yeah,
So
yeah.
when just helps you deal with whatever cancer you're.
Piyush,
Yeah, I
please.
think one of the biggest tailwind is UHI, right? I mean, if you look at it simply, even US, while they have all the electronic health record of patient, the system is not interoperable, which is getting built in India from the scratch. And I mean, there's so much of work happening when with 55 crore Indians already having a health ID. So I think that is going to be a game changer. It will take a while, but I think directionally it is going to be a massive area.
Pritika, please, I want you to come in on this question.
No, so look, certainly, like I was saying in the AI conversation as well, the holy grail of health tech is when you have all of this digitized data because of UHI. You have all of this access to diagnostic reports, and you're able to sort of use AI to provide suggestions or recommendations to doctors. A bit away from there, as we all know, but that's the way to go. And that's where we will see the most value from health tech from a software perspective, I would say. But having said that, because you talked about health tech per se and not just AI, I'll just take a step back. So there's the entire segment which is consumer facing, right? Which is diagnostics or service or health and wellness, sports, and so on and so forth. All of which, like we said, great place to be, and a lot of investor interest there as well. A lot of things have changed post COVID in terms of companies' potential to grow and people's awareness and therefore interest to spend on such things. But if you take a step back on health tech as a market, and you look at the health tech that's facing hospitals, the B2B side, right? So there's basically, I would say, two types of health tech. One, which is directly related to surgical diagnostic outcomes and so on. I would call that more med device, med tech kind of solutions. And then there's the one which is these days only focused on, let's say, billing, admin, digitization of records and so on, which is more admin process efficiency kind of.
It's not health tech per se, right?
It
That's
is
just
tech in
enterprise
it's
tech.
tech in healthcare, exactly, right? So I think, or even like so even e-consultations, which is all
Emergency response is one area,
online
right? Where there is some.
consultations and all of these things are all technically health tech, but all they are doing is improving process efficiencies, access, that kind of thing, right? Therefore, I'd say so on the med tech side, very clear. Everybody wants to invest and grow. In fact, there are a lot of Indian brands that are making equipment that's almost as good as the GEs, Siemens, the in the Linux that are
Abbott, yeah.
of the world, and they're selling, which is great, which is absolutely brilliant for India because A, it's manufacturing, and B, it's also technology. But on the other hand, on the health tech side, like I said, the holy grail is yet to come. So right now we have all of these, process efficiencies kind of plays, which will hopefully at some point of time lead to the, AI analysis, personalized medicine, everything that we want.
Sure. Piyush, I'd like you to share your experience with Eka Care.
I think from our perspective, we looked at a lot of B2C sort of health tech companies. Again, the challenge has been in India on the customer acquisition. Costs are high, monetization. I mean, very few players are able to demonstrate something meaningful. With them, they were one of the very few companies who actually qualified to work with ABDM, Ayushman Bharat Digital Mission, in the whole rollout. I think success rate was just 1%. They were one of them. Today, they are the largest private company after public sector who have created highest number of ABHA IDs, close to 5 million. And they have access to close to 115 million users. And there's a team which actually built Go IVO. So, I mean, they have built monetization models in the past, fantastic tech, working very closely with ABDM. This is going to be a great outcome for us. And as I said, it's directly aligned with where the tailwind lies. So they're essentially building the whole business model around it, doing quite well.
Thank you. One last question from me. I'm going to end on a more generic question, which we sort of started off the conversation with, and then we can do some Q&A. I wanted to touch upon that topic on unicorns, the fact that there were so many 2 years ago and only, a couple of them last year. Why are we so obsessed with them? What is the right time to list? Should one really wait? And Tarun, you spoke about a little bit of this earlier. It'd be great to hear from all of you on your take on this. Ashish, do you want to start?
Okay, I do feel that we do get a little worked up on the unicorns topic, and it is meant to be a milestone in the journey of the company to indicate a certain amount of maturity, a certain amount of scale, and the fact that at the bare minimum, while I would definitely love for it to come at much earlier stage, but at the outer limit, that's the stage at which the business looks like a business and no longer a startup. But I think we do get caught up in the valuation attribution of that at a billion mark, and we keep changing our benchmark. So from what was a unicorn in India at 6,000 crores is now 8,250 crores, right? I don't think we need to do that. Like I said earlier as well, at the big first question of yours, we are a different market with our unique characteristics and features. And personally, I do feel that we definitely have a scope and opportunity to list our companies earlier. We don't really need to wait, not even a unicorn. For that matter, half a unicorn is good enough a point where the business jolly well should be a profitable business. If it is, and if it is growing and has the potential to continue to grow, and the founder is clearly in his head more obsessed about running it as a business than the investor caring about the unicorn, you can go on the platform and let public make money. If it grows at 35%, it will still end up becoming a 10 bagger every 10 years. In the lifetime of the founder, it will be 100x from there on. So that's our take in general, and that's we have tried to walk our path as well, because at the early stage we have seen a little bit of activity in India with respect to the SME IPOs. So that's perfectly fine. We have had two companies walk down that exchange, and yes, there are benefits of scale, but nothing that can't be achieved post listing.
That's actually interesting, but I think Kunjan, do you want to contribute on this?
No, my perspective on unicorns is different, and I'm just looking forward to seeing more revenue-based unicorns rather than valuation-based unicorns. And there are a lot of examples, that whole cluster between off business, network, infra market. You have all the listed folks already there. be it a delivery, be it a Zomato, and a lot more are coming through. So I think on my wish list for the next couple of years is definitely sort of a unicorn based on revenue rather than valuation.
Great. Um, I think we could open the, you know, we could sort of open up some questions now. So, um, should I
Sure.
pass the mic down?
Perfect. So let me take the opportunity while the audience thinks of questions to congratulate Ashish and Tarun on couple of activities that I would say is evolving into the phase of radical transparency in the venture space. So Ashish, with the Omega files that you guys had released, I'd love to have you talk a bit more on what beyond the fantastic coverage in the media, etc. That what was the thinking in the organization and what were the results of that? And Tarun, on matrix moments, right? So I think we've seen a benchmark in terms of what the quality of the podcast and the radical transparency that you and your team have shown in terms of sharing some of the internal thinking and what's worked for you and some data on kind of what is the ROI on that effort for you guys.
Sure. No, Ashish, you should go. You put pressure on all of us with Omega Files, so you should go first.
By no means.
That's a very
So,
high benchmark.
so I think first of all, the credit should go to Karthik along with three of our colleagues, Aditya, Alok, and Mitul, for driving this. And at the origination of the thought process was that we wanted to just make sure that that entire journey of 11, 12 years, right from Fund 1, when startups was not even a byline, forget a headline on the front page. That's the era in which the Fund 1 started off. And the capital was raised from individuals, ultra HNIs, and taxpayer. So while I would have loved to simply say government, at the end of the day, the taxpayer money, by way of touching that, we have touched a much larger constituency. And it just felt like if we are going to continue to just talk about those conversations in a much private forum, yes, it's private capital, private equity, but why should it remain that way, at least from our side? So we just pushed ourselves a little harder and said, okay, if you have the numbers to talk about, might as well talk about it. I'll be candid. With much lesser performance, it would have been hard to do the same thing, and that's not something that would have crossed our minds, but not done it. But at the end of the day, if you have it and there are to be out there, might as well do that. Might as well do it every passing fund at the bare minimum. And it also would enable as good guiding posts for future generations of colleagues who are going to come in. There is a fair bit of content we try and put out there for people to have careers in VC, people who are coming and talking to us as to what does it take for me to scale up the business, founders alike, right? Not only just people who are going to come in and receive a check. These are people who are going to make a decision on the back of whether I should even ever go out and pitch for a check. We do tend to glamorize a lot about the VC world, but fact of the matter is that we are still less than 10% of the ecosystem. And there is 9x the ecosystem which still has built it the conventional way. So the idea was to go out with those challenges that we saw as during the early stages and have all of the stakeholders, whether it is LP who believes that, oh, there's always something more that you could have done to save this company, or the government who could have said that maybe it's just 10 years, it's enough. You should have wound up the fund well before that. So it's a variety of stakeholders that definitely have been asking a bunch of questions. What better opportunity than put all of those embedded into a bunch of those case studies? So that's the whole genesis and thought process.
Yeah, I'll actually start by firstly thanking Ashish and the entire team at Bloom, because I'll tell you the two other benefits that at least I thought about when I read that article. In the last 2 years, with so many IPOs happening, for the first time, we've started seeing a lot of interest from retail shareholders for participating in or investing in startups. And like it happens in every boom cycle, people think it's a get rich quick scheme. Oh, unicorn to aise banta hai, right? Like it's not so easy. And I think their post clearly outlined about how patient one needs to be to realize value from venture. It's a very, very hard business. Like founders think it's easy to be a VC. People outside think, oh, you get 100 baggers, like, every day. It's not the case. For every one that works, there's like 30 that you don't see that don't work, right? And so I think it showed how patient one needs to be. But if you are patient, the fact that this is now finally a viable asset class, I think that post brought it out really, really well, in my opinion, right? So thank you. I think you've done a favor, I guess, to everybody. Uh, I'll talk about matrix moments, and actually this one, Avnish, Rajinder, and the rest of the team who are doing it more actively deserve more credit. But since they're not here, I'll take the credit on their behalf. But it's been a fantastic experience for us. We started Matrix Moments. I think it's been now 6 or 7 years. We have now about 250 episodes live. I think it's probably India's most watched startup podcast. And it started with us, very carefully putting non-controversial, content. And then, we started getting a lot of feedback, which honestly was very, very positive. And it said, hey, you know what? I like this one point. And the feedback always, every time we were being authentic and genuine and actually opening up sort of the kimono, we saw those episodes would do really, really well. Right. And so we just said, what if we, to the extent to the, with the same sentiment that Ashish spoke, we said, what if we actually make all our thesis public? Right? We all the investors over here are thesis-driven investors. What if we make our thesis public? What if we talk about difficult topics like co-founder conflict? What if we talk about difficult, topics like if you have a term sheet from a larger fund versus a smaller fund, whose money should you take? What if you were to talk about, you have money from angels versus a VC, whose money should you take? And all and valuations and negotiating term sheets. We actually put out everything on negotiating term sheets, which was beneficial to founders. But technically, we put all our cards on the table and said, here are all the things we agree to, here are all the things we can't agree to. And so that became the starting point of a negotiation with us when we found ourselves in that situation. Very often, when I've given advice to founders, they actually send me a recording of a podcast saying, "आप लोग तो ये बोल रहे हो, लेकिन public में," right? And so it actually became but to that extent, it's created a lot more authenticity. It's given us a voice in the ecosystem. I will tell you one thing, like it has done wonders for us as a firm. It has given us some of our, like, we also end up doing events around these podcasts. So if I put out a theme, like we've done a podcast on neobanks well before neobanks was a theme that a lot of people were chasing. We set up an event around that podcast, and one of the founders, which is now a fund return company for us in that fund, actually attended an event because he heard that podcast, and he said, I decided that day when I heard the podcast कि मैं पैसे लूंगा तो Matrix से लूंगा. He had by the way 6 term sheets the day he started. Right. And so it's actually now that flywheel is really, really helping and turning for us. So I'm glad you brought it up, and I'm glad, that you listened to it. So thank you. And, our attempt is to just, with the same sentiments, try and demystify as much as we can around this whole sort of thing around venture capital funds and how they operate.
Thank you so much for the elaborate explanations. Thank you so much. Any other questions? Great. So I guess we can call it a bit early. So go ahead.
Thank you. Thanks, Arun. Thank you.
Thank you all.
Thank you.
Thank you.
Thank you. Thank you, everyone.
Thank you.
I would request all of you to stand up for a picture. I would like to call Uma Nagarajan on stage to give away the mementos from Zenith HR to all the panelists. Hmm. Thank you, everyone. Now we have our next set of awards. So the next award is for the Venture Capital Investor of the Year. This homegrown VC firm, easily one of the most experienced teams in the country, made as many as 10 part exits via secondary sales, totaling $178 million during 2023. Its exits include those are from retail unicorn Lenskart, SaaS startup Pixis, and baby products retailer FirstCry. It also closed $122 million growth fund during the year. To announce the winner of Venture Capital Investor of the Year, we invite on stage Puneet Vyas, Vice President Technology Holdings.
So the winner is Chirate Ventures.
To receive the award, we invite on stage Amish Dedia, Principal Growth, Tanvi Dubey, Head of Marketing. I would request you guys to, yeah, yeah, sure.
Hi everyone, I'm Tanvi Dubey. I head marketing for Chirate, and this is my colleague Amish, who leads on exits and is principal at Chirate. We're very glad to be accepting this on behalf of the entire team. And a big shout out to our founders, Sudhir and TCM, who brought together a stellar team that's been delivering now for 12 years consistent returns to our investors. And we're very thankful to Venture Intelligence for this honor. And I receive with Amish proudly this on behalf of the entire team to Team Chirate. Thank you so much.
Congratulations. Last but not the least, we have the final award of Apex 24, which is the Seed VC Investor of the Year. To announce the winner of the Seed VC Investor of the Year, I would like to invite Anil Goel, founder Cap 70 Angels.
Happy to announce winner for Seed VC Investor of the Year, Specially Invest.
To receive the award, we invite Vishesh Rajaram, Managing Partner, Special Invest. Congratulations, Vishesh. A couple of lines from you about your exit from Agnikul and about what other frontiers is special in exploring next, where no VC firm has ever.
Firstly, thank you, Venture Intelligence. Thanks for recognizing a small fund like us. It just means a lot for us to get this sense of validation and support from you and the rest of the ecosystem. We have a long road ahead from where we are. It's just 7 years in. We've got a few more decades to see through. So we'll talk more as we go through. Thank you so much.
Congratulations again. With that, we come to the end of our formal proceedings for the day. Thank you once again to all our sponsors, speakers, and very engaged participants. Thank you so much.